Tēnā koutou katoa. No mai haere mai ko Karis Halliday aho. It's great to have you here today for our Accounting Need to Know webinar for for-profit entities. This is our second time running the series. We aim to hold them every 6 months or so. They're a bit like a weather forecast for accounting standards. Today, Teresa and I will take you through at that high level of what's new and upcoming and some reminders relating to existing standards. At the XRB, we're responsible for developing and issuing accounting, assurance, and climate-related disclosure standards. Today, we're focusing on the accounting side of things for for-profit entities. Over the next 45 minutes, Teresa and I will take you through the topics listed on the slide. We'll save 15 minutes for questions at the end, but do please feel free to add questions at any time to the chat. A few housekeeping items. We will be making these slides available to you on our events page a day or so after the webinar, as well as a replay. And in some slides, we've added links so that you can easily access additional information. Please do be aware that the views presented today are the personal views of myself and Teresa and do not necessarily represent those of the XRB. So we're starting with a reminder about going concern disclosure requirements. They haven't changed since 2020, so there's nothing new as such here. But with many entities facing uncertainty and disruption in the current economic environment, which in some cases may impact their going concern assessments, we thought it would be useful to remind you of the New Zealand additional disclosure requirements. But before looking at disclosures, just to make sure we're all on the same page, let's think about what the going concern assumption means for a moment. So the going concern assumption is an expectation that the entity will continue operating into the future. This assumption affects how we account for assets and liabilities, and then how we present them in the financial statements. Today, we're talking about disclosures that relate to the going concern assessment. So I am keen to understand from you how familiar you are with the New Zealand additional requirements for going concern. So I'm going to open a polling question so that you can let us know just how familiar you are. So if you can answer that, that'd be great. Cool, lots coming in. Looks like a bit of a mix. A few people we've never heard of them, and then most are kind of in the middle of don't know much or fairly familiar. So I'll end that poll there and just share the results so you can see. Okay, thanks for that. So that's really useful context. So for those who aren't overly familiar with the background or even what the requirements are, you might be wondering, why do we actually have New Zealand additional disclosures rather than just those requirements that sit in NZIAS 1? So the reason for this is that the NZIAS 1 requirements are quite high level. The uncertain economic environment following the outbreak of the COVID-19 pandemic brought into focus the challenges with those high level requirements, as shown through diversity in practice on what was disclosed, calls from users for enhanced disclosures, and then also a disconnect with the auditing standard. Whether or not to prepare financial statements on a going concern basis is a binary decision, but those circumstances in which entities prepare financial statements on a going concern basis will vary widely. So the circumstances could range from when an entity is profitable with no liquidity concerns at all, to when it really is that close call to prepare the financial statements on a going concern basis. The degree to which entities explains their judgments in those closer call situations varied. So this is the heart of the issue that the additional disclosure requirements addressed. In 2020, we amended the New Zealand Standard FRS 44, New Zealand Additional Disclosures, with requirements that focus on situations where management has determined that the going concern basis of preparation is appropriate, but material uncertainties were considered in forming this view, or significant judgments were applied in forming this view. The accounting standards don't define material uncertainty because it depends on the company's individual facts and circumstances. Instead, judgment is required. For example, there may be a material uncertainty about the company's ability to deliver its strategies and to successfully implement its plans to address the events or conditions that led to an uncertainty. While responding to the increased uncertainty arising from COVID-19 was an initial driver for these proposals, for these requirements, they're just as relevant today as they result in more informative going concern disclosures in those close call situations. So there are 4 different types of going concern assessment outcomes. The New Zealand additional disclosures are focused on those 2 outcomes in the middle in blue on the slide. The first of these is when there's no material uncertainties, but significant judgment was applied in forming the view that the going concern basis of preparation is appropriate. So in that case, you need to disclose information about significant judgments and assumptions. The second case is when there is a material uncertainty about the company's ability to continue as a going concern. In those circumstances, you need to disclose information about events or conditions giving rise to material uncertainties, information about how management plan to mitigate the effects of any material uncertainties, and then information about how assets and liabilities may not be realised or discharged in the normal course of business. So if you aren't familiar with these New Zealand additional disclosure requirements, and you think there might be significant judgment or material uncertainties related to your entity's going concern assumption, then make sure you have a read of the going concern section, which is found in FRS 44. So Teresa's now going to take us through an update on disclosures of fees paid to audit firms. Thanks, Teresa.
Thank you, Chris. So at the end of the last year, we consulted on the domestic exposure draft on disclosure of fee paid to audit or a review firm. For simplicity, I will just call them audit firms. As you know, there are already requirements in FRS 44 to disclose fees paid to audit firm for audit and for other service provided. But we have heard calls to enhance these disclosures and improve transparency and consistency around the information provided in financial statements about the service provided to the entity by its audit firm and the fee incurred for those services. We propose specific requirements to disclose the fee incurred by the reporting entity for a service received for each audit firm separately for the audit or a review of the financial statements and for each type of other service performed by the entity's audit firm, while dividing the other services into 4 buckets as listed on the slide. For each of these buckets, an entity would need to provide a description of each service received and the corresponding fee incurred. We are very thankful for all the formal and informal feedback we have received. The feedback indicated overall support of the objectives of the proposals. Respondents generally supported the proposed categories of fee to be disclosed. However, some respondents requested further clarification and refinements to the categories and to other proposed related disclosures. Respondents also disagreed with the proposed disclosure on how the entity mitigates possible threats to audit independence. And we have heard calls for additional disclosures, disclosure concessions for Tier 2 entities. The New Zealand Accounting Standards Board and ZASB discussed the feedback received and decided to clarify that the first bucket, audit or review-related services, includes assurance services and non-assurance services such as agreed-upon procedures or AUPs, if the nature of the service is consistent with the description of that category. Further, we clarified that the agreed-upon procedures, depending on their nature, are classified as audit or review-related services or as other assurance services. It is the first or the second bucket of other non-audit or review services. As a result, we changed the name of the second bucket from other assurance services to other assurance services and other agreed-upon procedures engagements. We also removed the proposed disclosure requirement on how the entity manages possible threats to auditor independence when certain services are provided. But we would encourage you to disclose such information if it's appropriate. Last but not least, we extended the disclosure concession for entities in Tier 2, so that Tier 2 entities are required to disclose the total fee incurred for the audit or a review of the financial statements and the total fee incurred for all other services provided by the audit firm without the requiring of breaking down those into the four buckets. The project will be further discussed at the April NZISB meeting, and we are aiming to issue the final standard following that April meeting. The proposed effective date of the standard is 1st January 2024. I will now pass to Keris, who will update you about the activities of the Interpretation Committee.
Thanks, Teresa. Before we go through some recent agenda decisions, it is worth us talking about what the IFRS Interpretations Committee does and why it's important to keep on top of what they're doing. So the IFRS Interpretations Committee, also referred to as IFRIC, what they do as their main activity is to discuss application questions about IFRS accounting standards from stakeholders and then decide how to respond to those questions. When they conclude that IFRS accounting standards provide an adequate basis for companies to determine their accounting, they publish an agenda decision with explanatory material. In other cases, they might conclude that responding to a question requires standard setting activity. So why do we need to care about these agenda decisions? Well, because they don't change the requirements in IFRS, but rather show us how to apply the standards for a specific fact pattern, they may provide new information on application. So if your existing practice differs from that described in an agenda decision, you're expected to change your accounting policy to align with the agenda decision. This ultimately results in greater consistency of application around the world. So agenda decisions can be quite detailed, and there have been a number issued in recent months. We're going to focus on the first three listed on the slide today. We expect the last two won't be relevant to a large number of people on today's webinar, as those relate to multi-currency insurance contracts and to operations in hyperinflationary economies. But if these titles sound relevant to you, then please look them up afterwards. You can do that by clicking on those links. So let's start with this first one on lease accounting. So this is a tentative decision, and it relates to assessing whether a contract contains a lease under IFRS 16 when the supplier has particular substitution rights. Under IFRS 16, one of the criteria for identifying a lease is that the customer must have the right to control the use of an identified asset. There is no identified asset if the supplier has the substantive right to substitute the asset throughout the period of use. This is only the case if the supplier has the practical ability to substitute alternative assets throughout the period of use and would benefit economically from doing so. The request received by the committee referred to a 10-year contract to use 100 batteries for electric buses. For each battery, the supplier has the practical ability to substitute the battery throughout the period of use. However, for the first 3 years of the lease, the supplier would not benefit economically from exercising its right to substitute. For this reason, the tentative agenda decision notes that the supplier does not have a substantive right to substitute the battery throughout the period of use. Therefore, there is an identified asset, which is one of the criteria for a contract to contain a lease. The committee was also asked at what level to evaluate whether a contract contains a lease, by considering each battery separately or all of the batteries together. Because the customer is able to benefit from the use of each battery, together with the buses available to it, and each battery is neither highly dependent on nor highly interrelated with the other batteries in the contract, the committee concluded that the customer assesses whether the contract contains a lease for each individual battery. The deadline for commenting on this tentative agenda decision recently ended, so the next stage is for the committee to consider any feedback received. Okay, the second topic, this relates to a request about an entity's acquisition of a special purpose acquisition company, or a SPAC. The request asked how the entity accounts for warrants on acquiring the SPAC, and the SPAC had issued warrants to both its founder shareholders and public investors.
Keris, before you continue with this one, could you let me know what exactly is a SPAC?
Yeah, good question. So a special purpose acquisition company is a company that has no actual business operations, but it goes through an initial public offering, an IPO, to raise capital. The SPAC then purchases or merges with a private company. Because the SPAC's listed on a public stock exchange, the private company it acquires becomes public without having to go through the traditional IPO process on its own.
Okay, thanks. And can you explain what are the key accounting issues to look out for compared to other acquisitions?
Yeah, that's a tough one, as SPAC acquisitions are complex transactions and they can be structured in different ways. But the main areas to watch out for are firstly, who is the acquirer? For accounting purposes, it might be the SPAC or it might be the private company. The answer to that question would then significantly alter the rest of your accounting treatment. And then in terms of common accounting issues, accounting for financial instruments and share-based payment transactions are the two main areas to watch out for.
Okay, thanks. That sounds complex. But if I don't use SPACs, why I would be interested in this agenda decision?
So even if an entity doesn't deal with SPACs, if they do any acquisitions at all, then they might find some of the analysis in it useful on who's the acquirer, which IFRS accounting standard applies, what are the individual identifiable assets acquired, and does the entity assume any liabilities as part of the acquisition? So with all of that context in mind, let's have a look at the agenda decision. So the starting point is to consider who is the acquirer. In a SPAC acquisition, this does require really careful analysis and significant judgment. In this fact pattern, it's concluded that it's the operating entity. So then next we'd look at which IFRS accounting standard applies to the acquisition. The SPAC is not a business, so instead we're dealing with the acquisition of an asset or group of assets. This means that the entity is going to identify and recognise the individual identifiable assets acquired and the liabilities assumed as part of the acquisition. So that would lead us to, well, what are those individual assets and liabilities? So the only asset held by the SPAC is cash. So that's an identifiable asset. The entity also considers whether it assumes those SPAC warrants as part of the acquisition, and therefore whether it assumes a liability if those warrants are classified as financial liabilities. This is a big question. So the entity would do this by considering all of those specific facts and circumstances of the transaction, including the terms and conditions of all of the agreements within it. If this is relevant to you, you might want to read through the agenda decision. It steps through the accounting considerations, both for whether the warrants are assumed or are not assumed as part of the acquisition. It is too detailed though for us to go into that today. A separate issue here is whether the entity also acquires a stock exchange listing service. This aspect might be of interest to you as it considers whether that stock exchange listing service is identifiable as described in IAS 38 intangible assets. Spoiler alert, it's not. And then it also considers whether IFRS 2 share-based payments applies. It does, so you might want to read up on that part. That is all we'll cover for this one, and Therese is now going to take us through the one on lessor forgiveness.
Thank you, Keris. Well done, SPAC. It's hard. So in this decision, lessor forgiveness of lease payments, the committee was asked how the lessor applies requirements in IFRS 9 financial instruments and IFRS 16 leases to an operating lease when the lessor legally released the lessee from its obligation to make certain lease payments. Where some of the payments are already due but unpaid, means the lessor has recognized a lease operating lease receivable, and some payments are not yet due. So the committee concluded that even before the rent concession is granted, the lessor applies the expected credit loss model in IFRS 9 to the operating lease receivable. The measurement of the expected credit loss, except of other, includes considerations of the lessor's expectations of forgiving the lease payments. When the lease concession is granted, the lessor derecognizes the receivable related to forgiven payments in line with IFRS 9 and applies lease modification requirements in IFRS 16 and accounts for the modified lease as a new lease from the date the rent concession is granted. So now when we went through the topics recently discussed by the committee, we would like to ask you which of these projects will be the most relevant to your work. So thank you for starting the poll, Keres. I need to wait until the poll is finished to see the results.
Yeah, we're at about 30 of 111 people. It's coming in quickly though.
Thank you for that. Okay.
Just do another few seconds. Looks like we're about 60% answered. Shockingly, SPAC's not up there. That one's right on the bottom. Well, it did get a vote. So I'm going to share that poll now so that everyone can see it.
Okay, so that's a very close call between the definition, tentative agenda decision definition for lease and lessor forgiveness. Oh, okay, interesting. Yeah, that's a very useful feedback. Thank you for that. Okay, let's move on. So with this slide, I would like to take you back to our last Need to Know for-profit update in August, when we mentioned the committee's tentative decisions about cash received via electronic transfers. So just a quick reminder, the committee was asked whether the entity recognized the cash and derecognized the trade receivable once the electronic transfer of cash is initiated or once the cash is deposited on its bank account, which can be several days after the initiating the transfer. As the accounting requirements in IFRS accounting standards are clear enough, the committee issued a tentative decision that the cash is recognized only once it's deposited on a bank account, and the receivable is derecognized only when the contractual rights from receivable expire. However, the feedback received from constituents indicated that this decision may cause unintended consequences for other fact patterns and disruption to long-standing practice, leading to additional costs of applying the agenda decision. Therefore, the IASB decided not to issue a final decision and instead included this topic into a narrow scope standard setting project called Amendments to the Classification and Measurement of Financial Instruments. I will talk about this project shortly. So the next few slides provide update about international developments in for-profit standards. As you know, our New Zealand standards for for-profit entities are based on IFRS standards issued by the International Accounting Standards Board, IASB. The IASB has several narrow scope projects on the go, which might ultimately result in changes to our New Zealand IFRS standards. So the IASB is now consulting on exposure draft, which responds to OECD international tax reform. This OECD reform consists of two pillars, where the pillar 2 aims to put a floor on tax competition by introducing a global minimum corporate tax rate for large multinational enterprises. There is a significant uncertainty about how individual jurisdictions will implement the Pillar 2 model tax rules into their legislation and how entities will be affected. Therefore, the IASB proposes to introduce a temporary exemption to the accounting for deferred tax arising from Pillar 2 tax. The IASB also proposes to disclose certain information which would allow users of financial statements to assess the impacts of the Pillar 2 tax on the affected multinational entities. The consultation is open only until 10th March, and the new amending standards to IAS 12 income taxes may be issued as early as in April this year. There are two other exposure drafts on the horizon. So as I mentioned previously, the IASB is preparing a new exposure draft amendments to the classification and measurement of financial instruments. This project follow-ups recently completed post-implementation review of IFRS 9 classification and measurement. So the feedback to the request for information indicated that the classification and measurement requirements in IFRS 9 generally work well in practice, but the respondents highlighted some issues where the IASB decided to make narrow scope amendments to IFRS 9 and to IFRS 7 financial instruments disclosures.
Thanks for that background, Teresa. There is a bit in this ED. What are the main topics that it's going to cover?
So the main matters covered by these projects are clarification of particular aspects of the requirements for assessing a financial asset's contractual cash flows characteristics, also known as solely payments of principal and interest, SPPI test. The second matter are disclosures about equity instruments a company has presented in other comprehensive income rather than in profit or loss. And the third matter are the previously mentioned electronic cash transfers. So, and another project in pipeline are financial instruments with characteristic of equity. The main matter covered by this project is clarification how entity distinguish between financial liabilities and equity instruments, even for complex transactions. The project also explores enhancement of disclosure requirements around those instruments. So now let's have a look on recently issued amending standards from IASB. So the first one, lease liability in sales and leaseback, amends requirements in IFRS 16 and explains how an entity accounts for the sales and leaseback after the date of the transaction. Those amendments could lead to change in your current accounting practice. So that could be quite interesting. So what's happening? IFRS 16 already required that sales lessee may not recognize any gain or loss relating to the right of use it retains at the date of the sales of the lease, sales and leaseback transaction. But seller lessee could have had subsequently recognized a gain or loss on the right of use it retains solely because of a remeasurement, for example, following a lease modification. Those amendments clarify that such gains or loss should not be recognized neither on initial measurement nor in subsequent measurement of the leases. Those amendments are especially relevant to entities that have sales and leaseback transactions with variable lease payments. The amending standards is effective for accounting periods beginning on or after 1st January 2024, but once adopted, the entity needs to apply the requirements retrospectively for all sales and leaseback transactions that were entered into after the date when the entity initially applied IFRS 16. So a bit of work to do. The next one. So in October 2022, IASB issued non-current liabilities with covenants, which amends requirements in IAS 1 presentation of financial statements. It addresses concerns raised by 2020 amending standards classification of liabilities as current or non-current. The new standard modifies how an entity classifies debt or other financial liabilities as current or non-current. Specifically, it says that only covenants with which the entity is required to comply on or before the reporting day or affect the classification of liability as current or non-current.
Teresa, does that mean if I have a 31 December balance date and a bank loan with a covenant that is assessed, say, as of 30 June next year, that I don't have to take that into account when classifying that loan as current or non-current in my financial statements?
That's right. But you can't completely ignore those June covenants. You still need to disclose information about covenants you need to comply with within 12 months after the reporting period. Also, if applicable, you should disclose facts and circumstances that indicate that you may have difficulties to comply with those covenants. This enables users of financial statements to understand the risk that non-current liability with covenants will become repayable within 12 months.
That's helpful, thanks. What about if it's the other way around? Say my covenant is assessed on 30 November this year, so before my December balance date.
In that case, the covenant is assessed before the end of the reporting period and need to be considered. So, for example, if you are in breach of this November covenant to the effect that your loan is payable on demand, and you might be unable to avoid having to repay the loan within 12 months of your reporting date, and you need to classify the bank loan as current. I should also mention that the 2022 amendments defer the effective date of the 2020 amendments to the accounting periods beginning on or after 1st January 2024. The 2022 amendments themselves are effective from the same date, so 1st January 2024. Just please note that if you decide to early adopt the 2020 amendments, you need to adopt the 2022 amendments at the same time. So, Keris, could you now please update us about the new IFRS amendment standards in progress?
Yeah, absolutely. So our next topic is on IFRS projects where the IASB is getting really close to issuing an amending standard. So we've got two options that we can talk about today. So keen to know in this polling question whether you would like to hear about supplier finance arrangements or lack of exchangeability. If it's an even split, maybe I'll talk at a high level about both, but at the moment, it's looking pretty heavily on the supplier finance arrangement side. Just give you a little bit longer to get your votes in there. All right, gonna share that. So supplier finance arrangements by quite a reasonable margin. So let's chat about that one. So you might be wondering, what are supplier finance arrangements? So these arrangements provide the entity with extended payment terms or the entity's suppliers with early payment terms compared to the related invoice payment due date. So for example, an entity that buys goods and services on credit, the purchaser, might enter into an arrangement with a bank where the bank agrees to make a payment to the supplier of those goods or services, and then the purchaser makes payment to the bank. So such arrangements have lots of names like supply chain finance, reverse factoring, payable services agreements, trade finance, and vendor financing. So in terms of background to this project, the Interpretations Committee received a question about the information an entity is required to provide in its financial statements about supply chain finance arrangements. The credit rating agency that submitted the question said, based on its experience, entities provide little information in their financial statements about those arrangements. In response to that question, in December 2020, the committee published an agenda decision to explain the applicable requirements in IFRS standards. Although those requirements go some way towards meeting the information needs of users of financial statements, feedback on the agenda decision, including from investors and analysts, suggested that the information an entity is currently required to provide about this form of financing falls short of meeting user information needs. Users of financial statements want to understand the effects of these arrangements on an entity's liabilities and cash flows, as well as on liquidity risk and risk management. So this amending standard is intended to complement the requirements in IFRS standards that apply to supplier finance arrangements. So the amendments to IAS 7 Statement of Cash Flows and IFRS 7 Financial Instruments Disclosures will require entities to disclose additional information in the notes about those arrangements. So the ISB is getting close to finalising it. At its January meeting, the ISB discussed the effective date and transition requirements, however, deferred making a decision, and they're discussing it again during their meetings this week. In the agenda papers for their meeting, the ISB staff have recommended a proposed effective date of 1st of Jan 2024, but comparatives are not required. This differs from the exposure draft, which had stated a retrospective application would be required, but it was perhaps contemplating a later application date like 2025. So that's all I'll cover on here. Lack of exchangeability, you can read up on if that is relevant to you. So we're now looking at post-implementation reviews. So a post-implementation review is to check whether the effects of applying a new standard are as intended when the ISB develops the requirements, and it starts at least 2 years after implementation. Post-implementation reviews can identify improvements that can be made, so your feedback when these are open is really important. The IFRS 9 post-implementation review was split into stages. The first was classification and measurement, which has now been wrapped up. And you can read that feedback statement through the link on the slide. And as Teresa said, an ED with narrow scope improvements is expected soon coming out of this. The next stage for IFRS 9 is on impairment, and the ISB will be publishing a request for information on matters they've identified which need looking into. We'll share that request for information in New Zealand and then facilitate sharing New Zealand views back to the ISB. Similarly, the IFRS 15 revenue from contracts with customers post-implementation review will kick off later this year, and we'll let you know when that request for information is available and what approach we're going to take for gathering feedback. And then further out on the horizon is IFRS 16, that's likely sometime in 2024. So we have recently issued guidance to help with determining when NZIFRS 2 share-based payments applies. It goes through the sorts of transactions to look out for, and it's intended to help you identify transactions where you might need to go and undertake further analysis, like that stock exchange listing example that I mentioned earlier. Okay, so we do now have time for answering any questions. I understand that the chat function might not be working that great, but I think the Q&A function should be enabled. So if you've got any questions and you want to put those in there, now would be a great time. I'll check both in case. Teresa and I might get off very lightly if you've got no questions at all for us. Or it might be that the functions aren't working.
Hope not.
It looks like there's not much coming in. While you're thinking of them, I might just go back and talk about lack of exchangeability just at a really high level so you know what's in there in case it's something that you want to come back to. So lack of exchangeability. So under IAS 21, the effects of changes in foreign exchange rates. A company uses a spot exchange rate when translating a foreign currency transaction. However, in rare cases, it's possible that a currency can't be exchanged into another currency due to this lack of exchangeability. So that might arise when a government imposes controls on capital imports and exports, or when it provides an official exchange rate but limits the volume of foreign currency transactions that can be undertaken at that rate. So as a result, market participants are unable to buy and sell currency to meet their needs at the official exchange rate, and so they might turn instead to unofficial parallel markets. So although there's a few jurisdictions that are affected by it, it does have a really significant accounting impact for those companies affected. So the amending standard to IAS 1 will add these requirements of how to determine whether a currency is exchangeable into another currency, and then what exchange rate to use when it's not. And so that one's got a proposed effective date of 1st of Jan 2025. Okay, thank you. I have had a test question come in to see if it is working. Yes, it is. But I can confirm that there aren't any actual questions. But thanks for testing that out for us. Okay, well, if you have any questions later, you can always email them to us. We've got our contact details further down. So on the next slide, please. So we are checking in with a short stakeholder survey. It would be great if you could take part and let us know what you think of our performance. We really do value your feedback. So that is the end of the presentation. Thank you very much for listening. If you want to keep up to date with news about accounting standards or other XRB work, please follow us on LinkedIn, or you can subscribe to our newsletter. Tēnā koutou, tēnā tātou katoa.